Good afternoon, everyone. Today I'm chatting with Adrian Day. In this interview, we discuss the gold market, where it could be heading, and Adrian gives us his assessment on what's happening with gold equities, why we haven't seen the love yet, and what needs to happen in order to start to see gold stocks do their thing. All right, everybody, enjoy the interview. Adrian, thanks for hopping on today.
Well, thanks for asking me, Steve. Good to meet you.
So there's lots of stuff to talk about, especially right now with a new president in the US who looks like he might be the greatest geopolitical wild card we've ever seen. The first time he didn't come in guns ablazing like he is this time. There's just so much talk here in Canada about these tariffs, what they would mean, whether or not they're serious. And then even yesterday, the proposed Secretary of Commerce came out and said, oh, well, there might not be tariffs as long as you guys take the border seriously. But that didn't come from Trump or directly from the White House. It just came from one individual. So nobody really knows what's happening. And then, of course, there's tariffs on Mexico. There's a few minutes there where it looked like there was going to be some on Colombia. He's talked about 60% tariffs on China and walked that back to 10%. Anyways, what's your read right now on what's happening with the US and what that policy is ultimately going to look like?
Yeah, well, first of all, I mean, I'm not a political analyst, and I'm not, I don't have connections with the Trump administration. But it seems to me that there's, well, first of all, there's clearly a lot of uncertainty, as you mentioned. There's uncertainty about a lot of things, and of course, Canada's going to have a new prime minister at some point this year. Um, so there's a lot of uncertainty. I think the truth is that there's competing forces in the US, in the Trump orbit, shall we call it. There's competing forces on tariffs, what they're for, and therefore who they should be on and how much they should be. There's the camp that says tariffs should be very targeted, national security issues, so target China for things that we don't want China importing into the US, or Colombia if they refuse to take the deportation planes. Or as someone said, they should really be called repatriation planes, not deportation. But anyway, that's a political point. But then there's another camp that thinks that tariffs, and Trump thinks this, that tariffs should partly replace the income tax. I mean, it is not unusual historically for countries to raise revenue through import duties. Import duties sound a little softer than tariffs. Tariffs sound somehow punitive. But if you think of the Bahamas or Cayman, these are countries we hold up as great free enterprise bastions. But in fact, they raise most of their revenue, well, real estate taxes and import duties. So there is a camp that says we should, have 10% or whatever on everything that comes into the country, just as a way of raising tax. To me, the big issue, so we don't know how it's all going to play out. The big issue for me from an economic point of view is, are the tariffs high enough that other countries start to respond and we get into a tariff war? Because that would be, as we know from history, that could be disastrous from a global economic perspective. But the bottom line, I guess, at the moment is there is a lot of uncertainty about a lot of policies. And even if the intent is known, there's uncertainty about, how quickly and how dramatically they can be implemented.
So when I think about the tariffs, and I know that you're not a political analyst, but we still have to think about the stuff in terms of managing money and what that means in terms of risk and whether it's bullish or bearish. And the high level thought process I have is that it just means, in at least in the short run, we're going to see a pretty significant drop in GDP, and there's probably going to be quite a bit of inflation on the back of that as prices suddenly spike. Now, again, we don't know exactly how they would be rolled out, if there's going to be a grandfathering period or if they're just going to instantly put 25% tariffs on everything. At this point, we just quite frankly don't know. But I just kind of look at it and I think, gosh, this has to be good for gold prices.
Well, yeah. So I think you're right. And I mean, again, it depends on, how high the tariffs are and whether they're targeted or punitive or seen as a way of raising cash. There is an argument I should just point out. For example, France has higher import duties on California wine or on US wine than America does on French wine. So a lot of people would say, well, wait a minute, why is that? Is that right? Is that fair? Why is that? And but I think the plain fact is, you're right, that any kind of uncertainty or disruption is positive for gold, right? Gold is often viewed, if you ask the man in the street, or as we say in England, the man on the Clapham omnibus, what is gold? They'd say inflation hedge. But in fact, gold isn't just an inflation hedge. It's a chaos, disruption, uncertainty, a hedge against all of those things. So I think you're right. That's one of the things that's contributing to gold moving up.
So right now, when you're thinking as a portfolio manager, and I'm sure you're always looking at different equities, and your thought process changes, especially as the markets change. What are those things that are going through your head right now if you are analyzing, say, a gold equity? Whether we're talking about, let's just say theoretically, we're talking about producers, or I guess even all the way down to explorers. What is it that your thought process looks like right now when
Yeah.
you're
The,
talking
the,
about gold equities?
yeah. Well, the most fundamental thing for the whole sector, to me, is that gold is at all-time highs. Gold continues to move up steadily, not every day, but steadily, and it continues to have momentum on the upside, and yet the gold stocks are lagging. That is the first thing. Now, when we say the gold stocks are lagging, a lot of people are complaining to me about, oh, why don't the gold stocks move? Well, look at the XAU, look at the big cap stocks, the larger and medium-sized stocks in the XAU index. That's up 39% in the last 12 months. That is nothing to sneeze about, right? But the plain fact is that the gold stocks, and then particularly the juniors, the gold stocks simply haven't given us the outperformance that we expect at the beginning of a bull market. And frankly, when gold is at 2,800, and costs have not gone up commensurate with the rise in the price of gold, for the last 2 years, everyone analyzing gold stocks has been focused on inflation and costs going up. And every analyst call you get on, the half the time is spent on the company president talking about the steps they're taking to control costs. But the plain fact is, if you look at the last 12 months, costs have not gone up anywhere near as much as the price of gold has gone up, which means that the margins are expanding. To have expanding margins when gold is at an all-time record high is just a phenomenal scenario in which to be buying gold stocks. So that's where I start. And I start also with the fact that the gold stocks are very, very underowned. Very underowned. So you look at the US, something like 0.4% of the average portfolio is exposed to gold. Bank of America did a survey, and something like 78% of advisors said they had between 0 and 1% exposure to gold. And I would bet you that most of that was 0, not 1%. And so the potential for a change in sentiment among investors is very, very positive. And I'll just throw this out, if I may. I don't know the Canadian funds, and I really apologize. I mean, anecdotally I do, but the statistics. If you look at the GLD, which is the largest physical gold fund, it's had only 3 days of net inflows in January. That's with gold at record highs. People are still selling gold. If you look at a GDX, which is the senior gold equity fund, the largest one, and the GDXJ, which is called junior, although they're really intermediates, not juniors. If you can believe that, if you can believe what I'm about to say, the GDX and the GDXJ have both had 0 days of inflows in January. So despite what's happening with gold, the ordinary investor is simply not buying gold or gold stocks. And from a contrarian point of view, so when I look at gold at record highs, margins expanding, the average US investor, North American investor, because I talk to Canadian fund managers as well, the average North American investor, not just not buying, but actually still selling. And then on top of that, of course, the fact that the gold stocks are just ridiculously undervalued, then I think this is definitely the area in which to look. Now, do you look at seniors? You're probably going to ask me, do you look at seniors? Do you producers? Do you look at royalty companies? Do you look at exploration companies, et cetera, et cetera? And we can get to that. But that's my starting point. My starting point is that the gold stocks are extremely undervalued in an environment in which they should be overvalued.
I look at the returns of say the GDX, and it's up over the last 1 year, it's up 40%, but we're not seeing any net inflows. Do you think that the sentiment towards gold, that young people are just they've sort of bought into this crypto narrative? Do you think that it's just that everybody's got like 7 stocks that they want to own, Nvidia, Amazon, Apple, etc.? Why is it that they're just gold isn't sexy anymore with retail investors?
Right. Well, I mean, I think it's both of the facts you just mentioned. I mean, I think crypto to me has been a negative for gold, but a marginal negative, because but typical to me, in my experience, a typical crypto investor would not be buying gold if it were not for crypto. He would be buying the Nasdaq if it were not for crypto. So I think crypto has had an impact, but a marginal impact. But I think the basic thing is that everything seems to be good. The economy is apparently good. Inflation is apparently under control. The dollar is reasonably strong, and the stock market is apparently strong. Why do you need, in that environment, why do you look at, gold and gold stocks? I think that's the sort of narrative that people are creating. And the people that are buying gold stocks, the people that are buying gold and buying gold stocks are not buying them because of what I call the traditional macroeconomic environments for buying gold. They're buying because they are really concerned about, in North America, people who are buying gold are buying because they're concerned about the financial situation, about debt, about systemic risk. And you've got big institutions that are buying the gold stocks, but they're not buying the GDX or the GDXJ. They're buying individual stocks and moving the stock prices up.
So I had a really good chat with Rudy Frank from Seabridge. I'm not sure if you're in Seabridge in any of your funds. Um, and he always likes to talk about when we look at the majors, and like let's just say take a Barrick for example. I'm going to pick on them for a second, and we look at how much they've grown their reserves and how much they've grown their production over the last 20 years, and we look at that relative to how much they've grown their share count. I think, and I might be butchering this, but I think his line is, their reserves have been cut in half, their production's been cut in half, and their share count has doubled, yet their stock price over the last 20 years is flat. And then for those of us that are gold bugs that believe in the sector and think that it's only a matter of time until money does start to flow into it, and we think about why money's not flowing in. Do you think that there's an argument to be made that the majors just haven't done a good enough job of providing value for shareholders to really make it
Well,
sexy?
I think that's definitely true if you go back over the last 15 years. And, it starts even if you go back to 2010, 11, 12, when gold, or 2010, 11, when gold was at the previous sort of all-time highs. And the companies were just going out making these overpriced acquisitions of marginal deposits just for growth, right? Growth was the mantra. And in fact, some analysis done by John Tommaso shows that in the 3 years after 2011, over 75% of the capital spent on acquisitions was written off. Not written down, but written off. And so if we're gold bugs, right? So, but we're a small community. And for gold stocks to really move up, you need generalist investors. And a generalist investor who, they don't get in at 2000 or 2001. Of course, they get in as it's moving up. And then, after financial crisis, they say maybe some gold would be good, and they buy Newmont and they buy Barrick. And then you see these overpriced, ridiculous acquisitions. But at the time, people were saying that's a stupid buy. And the stocks go down, the XAU goes down 86% between 2011 and the end of 2015. That's the XAU. That's not the juniors. So is it a surprise that the generalist says, oh, forget about gold stocks. I don't understand them, and they're disaster. And then they finally start to get back into it. They say, well, let's buy Franco-Nevada. That's a really good conservative stock. It's a gold stock that works for you, remember? Gold that works for you. And then we have Cobre Panama. Not necessarily Franco's fault, but again, the generalist says, what's up with this sector? Everything I buy, turns into a disaster. So some of these are the company's fault. Some of them are not the company's fault. What's happening in Mali, I don't think is Barrick's fault. What happened in Panama is not Franco's fault. But nonetheless, the generalist just doesn't have faith in this sector. Now, I know Rudy, and I like Rudy a lot, but he probably didn't say what time frame was he talking about? Barrick's shares doubling.
I want to say it was over the last 20 years.
20 years could
Yeah,
be. Yeah,
yeah.
could be. Okay. I mean, I'm less concerned about the share count of the majors like Agnico and Barrick. I mean, Barrick and Newmont share counts have expanded, but they've expanded when they made a big acquisition, like Newcrest in the case of Newmont, or the merger with Randgold in the case of Barrick. Or Pan American when they bought Yamana, etc. I'm less concerned about the expanding share count of the majors. I do think there's a very, very significant problem with the share count expansion among the juniors, where you see stock counts double in 2 years, or I can give you examples where the share count's gone up tenfold in like 5 years. Now, if a share count goes up tenfold, that means that the company's value has to go up 10 times simply to make the value per share remain static. And that doesn't often happen. And I do think juniors are too free with issuing new shares. I'll say something controversial as well. I also personally think, against pretty much everyone else in the industry, but it is too easy in Canada. It is too easy to raise new money for junior gold mining companies. And I say that because you have the tax, you've got the big tax break on through shares. And so it is too easy for companies to raise money, which means that they're not good stewards of that capital. If it's very difficult to raise money, you tend to be a much better steward of the capital. And of course, as we know, for the last many years, for the last several years, every time company A raises money successfully, the investors in that deal are selling companies B and C and D to raise money to buy that share. We're not raising new capital in this industry, which is what we need to be doing, rather than just shuffling it around the chessboard. So anyway, but to get back to your point, yeah, I mean, let's face it, it's few and far between are the companies that have really done a good job. Among the seniors, Agnico stands out as a company that has really rewarded shareholders and has done a really good job. Whether it's their own fault or not, Barrick and Newmont have not. So that's 1 in 3 of the big cap stocks have done well. And you could go all the way down the list.
We'll wrap it up from here. What do you think 2025 looks like? Do you think that we see gold's over $3,000? What about silver? Do you think silver has a bit of torque in it here?
Yeah, I think, I mean, if you say 2025, we've got a long way to go, right? So to say 3,000 for gold is not a dramatic prediction in my view by any means. So, I think we'll definitely see meaningful new highs and in all likelihood over 3,000 and silver too. I think sometime this year, yeah, we're going to see ordinary investors in North America start to put more money into the gold equities. I think that'll happen when the broad market rolls over. And we're already beginning to see that. For all of last year, you could say, well, why look at gold stocks when the broad market's doing well? But now you look at Apple and look at Microsoft and look at Nvidia even. When these stocks start to roll over, people start to look for other places to put their money. And it may be, small cap stocks, it may be small growth stocks, it may be value equities or dividend stocks, defensive stocks, all the kind of sectors that have lagged. But among those sectors that have lagged are oil stocks, commodity stocks generally, and gold stocks. And so I think gold stocks are going to catch a bid this year. And of course, the gold equity space being so small, and let's focus on that, so small. All the top 100 gold mining companies in the world, and by top 100, you get down to some pretty small companies. You get down to several companies that are sub 100 million. The top 100 gold stocks in the world have a market cap of about $600 billion. The top 5 largest tech stocks in the US have a market cap of over 15 trillion. So you only need a very small amount of that money to flow from those tech stocks that are rolling over into the gold stocks that have lagged, and the gold stocks will do very well. And of course, there's nothing like success to attract new investors, right? When the gold stocks start to move up meaningfully, that's when the broad investor starts to invest.
And that's a take that I've kind of had too, is we need more wins to get the generalist involved, to want to invest. I mean, they're just like there hasn't been enough activity or wins, and even when we look at the wins that have been there, I'll throw Great Bear Resources out there. When we look at like who made money on that, I didn't know too many retail investors that were in on that name. I know Rob McEwen did quite well, um, but
Well, right, and the fact is, after they were acquired, then the play for generalist investors was over.
yeah.
You need a stock that's successful, but you can still continue to invest in. And there's a few, but few and far between. You're absolutely right.
Well, Adrian, thanks very much for hopping on here. It's great to finally chat with you. Um, uh, I I wish you a very successful 2025 in your investing year, and let's please do this again in at some point in the coming months.
Yeah, no, I'd really like to. Thanks, Stevens. Thanks for having me.
All right, everybody. Thank you for watching. If you enjoyed this interview, please smash that like button, subscribe, and ring that notification bell. Thanks for watching, everyone.